All right, everybody that's joining us this evening. We see participants are starting to arrive now that the webinar's started. I want to welcome everybody that's joining us. For those of you that are coming in using the link that was sent to you by Rick Bresler, you're going to be receiving an internal chat from Enid Lopez of StratiVentures directing you over to logging in as a non-panelist. Rick, that was a boo-boo. But it's okay for those of you, for example, that's signing in right now. Melissa, I think we're going to need everybody, please check your, how would I say this? Please check your
direct messages.
Your direct messages, because they're going to continue to pop up like this. And so let's get this thing moving here. All right. Let me make sure I got everything squared away here, guys. Okay. Okay. All right, everybody that's joining us this evening, we do apologize for the technical difficulties that we're having, but if you can see my screen, I do want to thank you guys for your time, and we're going to go ahead and do our best here to make sure the message comes across. This evening, we have Rick Bresler from Katy Capital Investments that's joining us, talking about Airbnb Financing 101. And remember that this is being recorded, so you'll be able to find us on all our social media platforms. And then obviously know that this event is for you, so we do encourage a lot of questions. We're going to get started on our topic here in just a little bit. For those of you that are joining us via Zoom, and now you're able to log into your own registration ID, the Q&A section of your Zoom is where we would like for you to put all your questions if you've got them. That's so our speaker and our panelists can answer them for you. I don't think we have any polls or surveys this evening. And then if you have any questions directed to the moderator, Enid Lopez, she's helping us from StratiVentures here in the chat. But if you are also joining us via the contact that was sent by Rick Bresler in his link that was forwarded, please check your chat boxes, because it's giving you instructions on how to move you to the attendee, not as a panelist. And remember, guys, this event is for you, so we welcome every question that you guys have. I want to introduce myself to you. My name is Diego Mello at StratiVentures. Just a little bit of information about me. I was born in Colombia, South America, and at the age of 4 came to the US. And I live here in Houston, Texas with my wife, Kate, and my son, Aiden. And prior to investing, I was a mortgage broker and asset manager. And I started investing in real estate in May of 2012. I funded my company StratiVentures that same year of 2012, and then in 2014 created the StratiVentures platform that is today. And now launched into 2020, we have our national platform, and we've got that number over, I think right now we hit 2,200 members, and we're in over 24 states. So to get to know a little bit more about us, please feel free to scan the QR code that you see at the bottom right, and it'll tell you everything about us. We are a full service real estate investment company, and we do handle all the 4 prongs of what we believe is a successful company: is acquisition analysis, real estate services, project management and contracting services, and also funding. And Rick, today you're going to be talking about a very special niche of funding that is in the real estate world, which is Airbnb. Our SVI team here is everybody that you're more than welcome to reach out to ask questions. They're on the StratiVentures Inc. StratiVentures.com webpage. You can get to know who they are, and also their full contact information if you wanted to know more information about that. And before we get started, Rick, I wanted to just let everybody know what at SVI the definition of a real estate investor is we like to ask people the question of, what do real estate investors do? And a lot of people say, well, they buy properties, they renovate, they help their community, they work with other people. So there's a vast, right? There's a different explanation in interpretation of what real estate investing is in the world of investing. But we like to tell everybody that works with us, there's only one definition. A real estate investor analyzes, acts, invests, and profits with one word in mind, and that word is risk. So can you imagine, Rick, if you had 30 different interpretations of investing, risks, drive in this world, how risky that environment is going to be?
Oh, yeah.
So we want to make sure we make everybody that works with us understands that at the end of the day, we're risk managers. That's all we are. We take the emotional side out, we look at data, and we work with the right people and the right vendors and the right team players that are going to minimize our risk, so we have a lower risk environment, a lower risk deal, and at the end of the day, we have success. So I wanted to share that with everybody to know where we're coming from. And Rick Bresler of Katy Capital Investments is actually one of our main lenders to our members, and he's here to share some information about himself and also about the company. So Rick, do you want to go ahead and give your bio, or would you like for me to share that? Because I know there's some things in there that you want to also share about your company.
Yeah, let me just go through it real quick, because I know we want to get to the meat of the subject. But then I want to say thanks, Diego, for inviting me on. Your program is always a pleasure to come on. And for those who are logging in for the first time, Diego's company, StratiVentures, is second to none when it comes to real estate education and all the other services that Diego provides. So you guys are in for a treat being introduced to StratiVentures tonight.
All right, thanks, Rick. So I'm going to go ahead, and I'm assuming you have your bio information in your presentation.
Yep.
So let's go ahead, everybody, and get started. I'm going to move now into Rick's presentation, and I'll be your Vanna White, if you want to call it, to your press. Oh, by the way, the other day we were watching the Wheel of Fortune, and I just so randomly decided to Google how much does Vanna White make a year. Well, how much do you think she makes a year?
She used to make 100, but she probably makes close to 200 now.
She makes $10 million a year.
Wow.
We're in the wrong business, right? Yeah, it's about 10 million. All right, take it away, Rick.
All righty. Yeah. So for those of you, thanks for joining us. We're going to be going through this stuff kind of quick. So I don't know, take screenshots as you go. This is going to be kind of like drinking from a fire hose. Diego, if I start going too fast, slow me down. I've got words, I gust up to 500 words a minute. So sometimes I gotta get slowed down. But anyway, so this is our contact details. Next slide.
Okay.
So Katy Capital Investments, just quickly, I started buying fix and flips back in 1985. I've done over 70 flips myself. I was the master of the side hustle, had my oil and gas job as a project manager, project director, but couldn't sit still and did a lot of real estate on the side. I was lucky to be sitting on a lot of cash, and after the 28, 29 debacle, and I bought a bunch of rentals back then. I wasn't very smart because I thought the market went up too fast after I bought them. So I was waiting for a dip. The dip never happened. Ended up refinancing all my rentals, then had all this money left. And so that kind of got me started in private money lending in 2013. But I bought, today I have long-term rentals, I've got short-term rentals, and I've got vacation rentals. So we know what investors are looking for. We're investors ourselves. So we're investors lending to investors. So we get it. I think Diego's the best at mentoring, but I think I'm kind of a distant second behind Diego. Started private money lending in 2013. We formed Katy Capital Investments in 2017. We have done, we did our first ground up construction back in 2018, have more planned. So again, investors lending to investors. Next slide. And then just real quick, so we do all kinds of lending, fix and flip loans. We do both the private money or hard money. We lend nationwide. We do Airbnb and long-term rental financing, portfolio loans, new construction, multifamily, and mixed use. So We're like to say a one-stop shop for real estate investors needing funding. Next slide. All right, so before we get into financing your Airbnb, I think it's important real quick to understand where we're at in the market with interest rates. Because what we were doing a year ago when I was refinancing my rentals at 3.49%, and a lot of others were where we are now, you can see over the last year, we were in a wonderful, blissful period back May, June, July, August, September, November, getting the investor rates as low as 3.49%, 30 years fixed. That was as good as it ever was, and it's probably as good as it ever will be. Those days are gone. Which you can see in the last couple of months. Now this chart here shows conventional mortgage rates. Investor rates are about 1% more, but it's just in the last couple of months. Today, I think the conventional mortgage rates are the highest they've been since 2019. I got my next slide shows that at 5.25%. And investors were getting 3% loans, a year ago. And the rates, currently the rates follow the Treasury yield 5 years. So I put the little ticker for that in case people want to follow that. But anyway, so we're in increasing rates and they're changing every day. So it's almost impossible to get a rate lock. If you do get a rate lock, it's expensive and for a short duration. It's madness out there right now, but maybe we'll talk a little bit more about that later. Next slide.
And Rick, one of the things, remember when they were talking about the rate increase, Goldman Sachs predicted just the year alone 4%, a 4-time change, and then they moved it to 7. And now they just brought out last week that over a 2-year period, there's going to be an 11-time change on rates that they're predicting.
Yep.
11.
So this is today. So the conventional 30-year fixed rate today was 5.25%. So that's like, that's basically almost twice as high as it was last summer. So that's just to give you an idea of, you can see that the chart shows January, February, March, April, how rates have gone up. And we're just in that environment where you call a lender, he's going to give you what the rates are today. We'll talk a little bit more about rates towards the end of my presentation. Everybody wants to know what's your rate. We'll talk about rates, but it's a moving target, and anybody who quotes you any kind of rate, there's a good chance it's going to change by the time you close. And trying to get locks is going to be very difficult. So that's just the market we're in. Next slide. But as bad as it looks, right? This is the 30-year history of rates. So I started investing back in 1985. So you can see I was baptized in real estate back when rates were over 10%. So it's all good for me. But for those investors that have come in the last few years, we think the sky is falling, but even at 5%, we're still at 30-year lows. When you look at the big picture. So basically, we're back to like 2019, even back to 2009 now, with rates over 5%. And again, this is just reflecting conventional. Investor rates are about point and a half higher than this. So just everyone knows that rates are increasing. Now there's 3 types of money out there. There's the money, most lenders, the loans are sold, are bundled and sold as mortgage-backed securities. And then the bond market makes a big difference on those. There's also lenders out there that use bank money. And the mortgage-backed securities pretty much will follow the trend of the 5-year treasuries. The bank money will follow what the Fed's doing, because the bank's cost of funds isn't linked to mortgage-backed securities. Most banks they're holding their own paper. That's going to be more of what the Fed's doing. And then you have insurance money. Now we've got lenders who are insurance companies, bank companies, mortgage-backed security types. So each one has their sweet spot depending on where we're at in the market. So that's what's good about us. We can get you the best rates based on which source of funds is the most competitive, and we can talk about that a little bit later. But anyway, I want everyone to realize we are in an increasing rate environment. The Fed Chairman Powell blew it a couple of months ago. He should have started increasing rates earlier. He didn't. Now he's trying to make up for it, and it's going to be interesting times for the next rest of this year. And we can go on. That's a whole nother show there I can talk about. All right, next slide. All right, so how to finance your Airbnb. There's 17 ways, but we're just going to talk about 5. I might do some honorable mention on the kind of the what I call the weird stuff when it comes to wraps, this, that, and the other. But for the most part, people are looking at want to know about the long-term financing. And like I said, this will be like drinking from a fire hose. So if you're going to do screenshots, be quick on the trigger. We're going to go fairly quick. Next.
And this is being recorded, and you'll be able to find this recording on our StratiVentures YouTube channel.
Oh, good. Conventional financing. All right, you cannot originate a new loan for Airbnb on a conventional financing. The only way you can use conventional financing is basically if you had an existing note on a long-term rental, and now you want to convert it to an Airbnb. So you can certainly do that. But if you have an Airbnb you're wanting to purchase or refi, it's not going to happen with conventional financing. Next, with the exception of a second home. Now you can buy a second home. It's conventional financing with a 30-year mortgage. Rates are going to be, well, when I did this slide, it was 5%. It's probably closer to 5.5, 5.25, 5.5 now. These are full doc loans. You got DTI less than 40%. The good thing about this is you can get in with 10% down. But it can't be local. Typically, second home needs to be 100 miles away unless it's some anomaly, or if you live in a destination spot and you're buying a second home in a destination spot. And you're going to have to occupy that property some of the year. They don't define some, but figure you need to spend at least a week at that property to get the second home. But for those that can get conventional financing, a second home is a good hack to where you can get in with 10% down or 15%, whatever you want to put down. But everything else is going to basically be in the 20% range. Next slide. Another little financing hack is an FHA 203K loan. So for those who want to live in a duplex, a triplex, or a fourplex, you can buy that, and then you can rent those out however you want. So, as a matter of fact, it was this strategy that got me involved in real estate back in 1979. I heard about this after now I'm dating myself. When I graduated from college, moved down to Texas, a guy was talking about doing this back then, and that's just like, man. So I was out of college. I needed to live cheap, and that sounded like the thing to do. So that's what actually got me into real estate. But that program's still going on. If you do it, you do have to live in one of the units for at least 12 months. You can rent out the others. It's a full doc loan. The beautiful thing about this, you can get in for 3.5% down, but that comes at a cost. So it sounds good, but it does have cost. FICO scores over 580, so that's another program for low FICO scores. But defaults are big concerns with these, so that's why private mortgage insurance is required, and it's going to cost you 1.75% up to 2.25% upfront premium, and then you're going to be paying 0.5 to 1% annual premium for the life of the loan. The only way you can get rid of the PMI is if you put at least 10% down, and then when your loan becomes 80% of the value, then you can drop PMI. But if you're coming in at 3.5%, you have to pay the PMI for the life of the loan. And if you add all those premiums up, there's a lot of money in those premiums. And you can only have one FHA loan at a time. So this is like a one-off. But I figured it was worth mentioning to those who, especially a younger crowd, who this one might be appealing to them.
And Rick, one more thing there is once you hit that 80% loan to value ratio, they're not going to call you and remind you to take it off, are they?
That's right. Now you're going to have to go, you're going to have to ask.
You're going to have to ask. So nobody's going to tell you, you can stop paying us. You have to ask.
You have to ask. All right, next. Oh, now regional bank financing. That may be the lowest interest rate going on right now, but now when I'm talking about regional banks, not all banks are the same, and there's exceptions. But most of your banks are going to do a 20-year AM with a 5-year balloon. There are some banks that may do a 25-year AM, no balloon. Very few of it will do a 30. But most of your banks are going to be 5-year, 20-year AM. The rates were a little lower than the conventional rates at the time. I was talking to my banking guru. But they were going, they had just bumped up to 4.5 to 4.7 after the first Fed rate hike. But as the Fed keeps hiking rates, these bank rates are probably going up in lockstep. These are full doc loans, debt to income less than 40%. They want FICOs over 640. They'll do 80% purchase or a 75% cash out. They need a DSCR of 1.25. And for those of you who don't know what DCSR means, that's basically they want a 25% positive cash flow. So they take your rent and divide it by your PITIA payment. And as long as that ratio is 1.25, you're good. If it's less, then that just limits how much you can borrow. But think of DSCR as your cash flow. And right now, at least the bankers I was talking to, there's no rate locks, because the last thing they want to do is get a loan. And if they want to sell it off, they can't sell it without a steep discount because the rates are too low. So everybody doing mortgages right now are in a very conservative mode. Time to close is typical 30, 45 days. All right, no other questions. Go to next. All right, so really the hottest product on the market over the last couple of years, especially for real estate investors, has been the non-QM loan. And it goes under different disguises. The non-QM, they call it bank statement loans, no income loans, DSCR loans. All these nicknames are basically for the same product. And you can get, if you're going to buy a rent ready, you can get 80%, you can get 80% financing. You have to put 20% down plus closing costs. Or you can get 80% on a rate and term. There was some 85% available, but most of the 85% programs have gone away. There was too many defaults on them. And rate and term simply means if you have, especially if you have a hard money loan, you can refinance that loan and roll in all your closing costs and even get cash back up to 80% of the appraised value. So, so that's what a lot of my borrowers do. They do a hard money loan with us, and then we refinance them into a rate and term, or 75 to 80% cash out. Most lenders are going to do 75% cash out. I've got a couple. If you have a 760 plus FICO score, you can get 80% cash out. So that's pretty awesome. Rates, they're heavily FICO based. If you're going to be a real estate investor trying to use cheap money for financing, you've got to get your FICO scores up at least over 700. So now minimums are 620 to 650. There are some lenders out there that'll go 550, but your terms are going to suffer. You're going to have high interest rates and low leverage. Your loans are going to be very expensive. 700 usually can get you the max leverage, except for the 80% cash out. You got to be 760 for the 80% cash out. And if you're 720, 760, most lenders, you actually get the best interest rates. So these are low doc loans. So low doc loans mean the next bullet, there's no tax returns, no pay stubs, no debt to income. We don't worry about that. You just got to have a bank statements that shows you got the liquidity. your LLC docs, driver's license. We got to get a verification of mortgage and pay off from your hard money lender or whoever else you got a loan with. If it's a purchase, we need a copy of the purchase agreement. We need lease agreements. On the long-term rentals, we'll talk about the short-term coming up. 2 months proof of rents. So that's pretty low, doc, and you're in and out. The DSCR needs to be 1.1. There are some that will go to 1.0, but they're qualified at one. It's not really a 1.0. They say 1.0, but it's almost false advertising. It's still going to be a 1.1. They're going to want to see you have about at least 10% cash flow. Time to close 30, 45 days. So that's the basics on these. I got 5 more slides on this, I think. Go to next, Diego. So very important. Why is DSCR so important? Because it will cap your leverage. And this is really important when it comes to Airbnb properties. So affordable houses, like for example, I've got an Airbnb property off of I-10 in Greenhouse, which is close to all those hospitals. So it's great for traveling nurses and stuff. It's a $200,000 house. So when they do an appraisal, they're going to do what they call a 1004, which is the sales comp, and a 1007, which is the rent comp. And you can get, you can just use the market rent if your house has not been a short-term rental. Like if you buy a house to be a short-term rental, obviously it hasn't been a short-term rental yet. So if you have an affordable house, the market rent will almost always work, and you can get maximum leverage. Medium price houses, if they're in the $300,000 to $500,000 range, the market rent may not support max leverage, especially at our higher interest rates. Last summer when we were 3.49%, 4%, 4.5%, the DSCRs were really no issue back then. But now these higher interest rates, the DSCR is coming in to cap a lot more mortgages. And on the high-end properties, market rents almost never works. We got a $1 million beachfront house that we're refinancing. We have 2.5 million. First of all, trying to find a long-term market rent to use as a comp doesn't exist because everyone's Airbnb in those anyway. So those can limit your leverage. So for Airbnb DSCR calculations, we can use a long-term market rent as a fallback. Some of our money sources can use the AirDNA. I jumped to the third bullet. Can use the AirDNA analysis, but there's a couple little caveats on those. And of course, if you have Airbnb income history in future bookings, those can be used as well. So all these loans, all these non-QM loans, basically they're all DSCR requirements that can cap your loans. That's one of the things we do when we look at loans. We help look at all that, and we've got ways to maximize those. The next slide. Okay. So basically, there's 5 types that I've got right now. There's 30-year amortization, which was a no-brainer last year at 3.49% interest rates. There was really no reason to do anything else. The times have changed. They go back, Diego, somehow that.
Oops. Sorry, but hold on.
The other back. There you go. There's 5-year interest only fixed and 10-year interest only fixed. So what that means is that you can get a fixed rate. Let's just say it's 6.5% for 5 years or 10 years fixed. And then at the end of 5 or 10 years, it just turns into a 20 or 25-year amortization. So they're 30-year loans, but the interest rate is still fixed. So you don't have to worry about rising interest rates in the future, but those rates are a little bit higher than your 30-year fix right now. And then there's 5, 7, and 10-year ARMs. So those are still 30-year loans, but they're fixed for 5 years or 7 or 10, but then they turn into adjustable rate mortgages. And and I never thought I'd be a advocate of a 5-year ARM, but in this market, because of the differential rates, those are actually something to consider. And I've got a refinance, and this may be the first time in my life I'd ever even consider a 5-year ARM, and we'll talk more about that in a little bit. So next slide.
So would you say, okay, I'm sorry, you'll probably talk about that in the next slide. Okay.
Yeah. So to give you a little bit of idea of where we were on rates yesterday, the bond market went up again today. So there's probably going to be a lot of people increasing their rates tomorrow or the next day. This market is crazy. But 30-year fixed. Now, when I put these rates out there, these are rates for like a 760 borrower doing 75% cash outs or 80% purchase. Rates vary depending on all kinds of stuff. But just for these rates is for a fairly decent FICO score, either 80% purchase, 75% cash out. 30-year fixed, 6.75, can even get into the 7s. 5-year interest only in the 10-year, or just right at 7, just a hair above 7%. 5-year ARMs, 5.25, 7.550, 10-year 5.75. And that 5.25 right now is like, wow. That's, and I'll show you the impact that has. But like I mentioned, experience, FICO scores, the amount of leverage you want, the loan type you want, and these are all at par, right? All these are par, means there's no buy down points. You can't buy the rates down. And then during the summer, the buy downs actually made sense. But now nobody wants to get stuck with these with low interest rate loans. So the buy down fees are expensive and basically not recommended. All right, next slide.
And I guess that was the question I was going to ask. For somebody that's looking at a 5-year interest only adjustable rate mortgage, they're also governed by, once they start making their adjustments, a maximum and a low that these things can rise, right? Depending.
Right. So yeah, basically, yes. Basically,
A floor and a ceiling.
Yeah. So basically, the ceiling is 5 points. So if you were to get a 7% loan, it couldn't go more than 12% over the life. They call it 225s for most of these, so they can go up 2%, and then no more than 2% any one time, no more than 2%, I think, in a year, and no more than 5% in the life of the loan. So something along those lines.
And hope you hope your property performed well before those things start.
Right. If you're going to get those, especially the ARMs, the reason you get the ARMs is because you want to be prepared to refinance, probably in 3, 4, 5 years. There's prepayment penalties. There's some more gotchas in there that we'll chat about. There is no perfect bullet.
Right.
And so why interest only? It's going to lower your monthly payment, which helps your DSCR. I got some examples on the bottom of the slide. And last summer, at the 3.49% interest rates, the savings you had in your monthly payments was less than the principal reduction you'd have over the time period over the course of the loan. So it didn't really make any sense to do interest only, because you were going to have more principal reduction. At these higher interest rates now, and we show our borrowers these numbers, your interest rate savings over like 10 years is considerably more than the principal buy down at 10 years. So everything got turned on its ear over the last year on the Ys. And prepayment penalties are less on a 5-year. Most of your loans are going to have 5-year prepays. Some people even have 7-year prepays. We don't have anything with 7-year prepays. Your 5-year loan will have a 3-year prepay. But let's look at the borrowing power of the different rates. So if you have 6.5% 30-year amortization loan for a principal and interest payment of $1,160, your loan amount would be $183.5. But if you had a 7%, so the interest rate's a little bit more, but it's 10-year interest only fixed, you could actually borrow 198.5. So you could borrow 15,000 more going with an interest only. And right now for the 5.25 5-year, you could borrow 265,000. So you can see on an Airbnb property, you could borrow a whole lot more for the same payment. And some of our Airbnb folks are forced to go into interest only if they want to try to maximize the cash outs. But that's the huge power of these interest onlys now. So next slide.
And you would say, Rick, that obviously having more purchase power for the Airbnb arena is because Airbnb also defines by location. The better the location, probably the better the premiums, the more cost it is to get these, you want to move into something of a product like this.
Right. And if you listen to the gurus, and for all your listeners out there, Diego, have you ever heard of Barry Habib?
Yes.
All right. So he's probably considered the best of the best when it comes to the mortgage business, interest rates, and the economy. If anybody, he's expensive to join his tribe. He's got a monthly fee of $100-something a month to join, but he's very good. And in my meetups, sometimes I'll show what he's doing, what he's sharing. But his thought is, since we're having the inversion of the 2-year and 10-year treasury curves, that's always precipitated the upcoming recession in the next 6 to 12, maybe 18 months. He's thinking we could come into a recession maybe in 2023, could be a little bit later, but could be as early as the end of this year. When that happens, interest rates are likely to fall again. And especially for conventional loans, he's advising his people to get 5-year ARMs, because on an owner-occupied home, there's no prepayment penalty. You get 5-year, you pay a little bit higher interest rate. Don't pay any fee, don't buy down, just get in with his minimum fees, with the idea of being able to refi in 12, 18, 24 months, because you're going to be able to get better rates. He believes in that time period. So it kind of makes a lot of sense once you understand the relationship between what the Fed's doing, the Fed rate, the mortgage-backed securities. If you get a chance to go on YouTube, and I would definitely recommend searching for Barry Habib, and anything you can find recently in March. He's got a couple out there in March. Listen to his YouTube videos. Very knowledgeable, very good stuff. And you'll have a better understanding what's going on. So I digress. Sorry about that, Diego, but I thought that was good stuff.
No, it is, because with such a moving ocean of interest rates, is the way I like to call it, you need to not just be looking at the ocean, you got to be looking at your navigation tools. And Barry's information is allowing you to look at the navigation tools, so you don't need to look at the ocean. Make sense? And most people just rely on what they think the ocean's doing. And so that falls under perception of, oh, it's too rocky or it's too wavy. But in fact, it might just be a different, let's turn the boat this degree and it'll be a little bit different. That's kind of the way I see it when I look at financing.
Yeah, because we're in uncharted territory right now.
Yes, absolutely.
We've never had interest rates going up, inventory at such a low supply, and predicted to stay low supply for the next 4 or 5 years. We cannot build fast enough for the demand. With inflation and you hit a recession coming potentially, we really haven't been in these waters. But the bottom line is, if the numbers work, keep investing. Deals may be a little harder to find, but if you find a good deal, the numbers work, there's no reason to stop. We're still at decent interest rates historically. So definitely don't, I still think today is still the best day going forward to be buying real estate. Mm-hmm. It's not going to get any cheaper.
Yep.
And you can always refi to lower your rate in the future. So but anyway, I digress again. So Non-QM continued. So prepayment penalties, I mentioned before, 5-year prepayment penalties are most common. 3-year and the 5-year arms, which kind of like. And there are buy downs available, but I don't like buy downs now. They're too expensive, to not enough bang for the buck. Seasoning. All right. So if you bought a house, if you went down and bought a foreclosure, you paid cash for it, or you got a hard money loan just recently, and you can cash out of that thing under the delayed fundage. You got 90 days, some even a little bit longer, but you got basically 90 days to do delayed funding. And what they'll do, they'll give you 80% of your purchase, 80% of your purchase plus repair if you actually did some repairs. And that works if you did not force a lot of equity. Right? So if you bought a foreclosure that was pretty much ready to go, and it's going to appraise for about the same as you bought it for, you just want to get funding, you don't have to wait. You can go ahead and get funding now. But most of our investors are pretty smart. They buy a distressed property, they put a rehab on it, and now they force the appreciation up $50,000, $60,000, $100,000 or so. And if you want to cash out on that higher appreciation, then you have to wait 90 days if there's a loan on it. If you have paid cash, most lenders require you to wait 180 days before you can refinance out of that. So if you paid cash, either refinance during the delayed funding period of 90 days, or if you want that forced appreciation, you're going to have to wait 180. And never really got a good reason why that rule, except supposedly it kind of puts the kibosh on money laundering, so people can't launder money. I don't know if that's really true or not, but that's the rule.
It is. That is the primary direction, because real estate is the I'd say the number one harbor of capital participations. That's why title companies exist. And what do title companies what do they not collect? Cash, but they also can verify third-party accounts to do that. That's exactly, I was under the same thing too. I was going, wait a minute, why am I being penalized here?
So you think all those hotels in Cancun and stuff?
Yep.
What's the little money going to those resorts over there?
Oh yeah.
Yeah. For the most part, your entity must be in an LLC, or it can be in your IRA. There are some minimal exceptions, but most of these non-QM loans require they're only going to loan to your LLC. And like there are non-recourse loans available. We do a fair number of non-recourse IRA owned properties. And the leverage is going to be 60-65% on those. Yeah, the minimum size, the factor, homes need to be at least 600 square feet, preferably over 700 square feet for a single family, 500 square feet for a condo. We might be able to get a little bit lower, but if you're looking at tiny houses, or a lot of places might have 250, 300 square foot efficiencies, you're going to have a hard time getting those financed. I can't do them. And I had a sweet little 7-unit deal in Galveston I was going to buy. Then I found out they were like 250 square feet a piece. Shoot, I couldn't finance them. So I had to tell the guy, sorry, I can give you about, since I can't finance them, I can give you about 50% of what we're talking about. But if that's not of interest, I can't finance them, and probably nobody else can either. So you're going to have a cash buyer.
Yeah, and those tiny homes, the majority of them, because there's engineering factors, a lot of them come on I-beams, which are going to be seen as a non-deeded, more of a titled item, and you're going to have problems with that too.
Yeah, I know a lot of guys doing tiny homes and stuff, but they're doing them with private money.
Yep.
I call them every 3 or 4 months to see how they're getting financed, and they can't get them financed.
Right, not there yet.
These guys that do container conversions and stuff and do them.
Oh yeah.
Yeah. So minimum loan size and such. So most lenders need the property to appraise for at least $100,000. Minimum loan size is 50,000. Sometimes there's exception to those. I've gotten a few. We did a loan where the appraised value was like 87,000. I got that one through, but basically, you want to have properties that are going to appraise over 100, and be sure it's worth 100. Don't hope it's worth 100, because you're going to pay for an appraisal and find out that you wasted, $700 because you hoped it was over 100. You didn't do your homework, and and then rural area, there's very few lenders that do rural areas. Some banks and stuff will, but if you have a rural area, I've got one lender that'll do rural, because there's some beautiful Airbnbs out in the Appalachian Mountains, out in hill country. They're out in the middle of nowhere, and they do great, but it's considered rural. So those are harder to fund. They're going to be a little more expensive and a little more questionable. So they can be done, but before you buy it, or before you get more than the option money in on it, check and make sure it's financeable. Otherwise, you're paying cash. So,
and your local community bank, what we found out, because out in Bernie, out in those areas, for example, the hill countryside of Texas, we checked with some banks, and they'll want you to have minimum a 2 trade line relationship with them, which is basically a deposit account, and then they're going to want you to have something of the business account that's going to be operating that Airbnb through that bank. And then I think they weren't asked, I think they were at 65%. I mean, I'm going, wow.
yeah.
Pretty aggressive.
Yeah. All right, next. And these are some other ways. I'm not really going to go into them, but obviously the no-brainer. You got cash, friends and family, credit cards. Now, by the way, I put these on here because I've done all these. All right. So HELOCs, lines of credit, private money or hard money, different seller financing terms, partnering. But that's all stuff that really is kind of beyond the scope of this presentation. But I just kind of wanted to bring it up. If you've got a deal, there's ways to find money for it. It may be shorter term money. It may be thinking out of the box. And there's other ways. These are just the ways I've done things. If you haven't got a HELOC, get a HELOC. That's the best insurance policy you have in case things go bad. Lines of credit, if you can get those. That's definitely things. Get your credit cards up. I've had to buy houses or put a lot of them down payment on my credit cards. Back when I didn't have a whole lot of cash. So
and that's when you wished the airline miles were going to be applicable, right?
Yeah. I think that's it. Do I have anything else on the I think that may be my last slide.
No, that was the last slide. So let me go ahead and move here, guys, into the Q&A section, but also want to put Rick's contact information, so you can get familiar with Rick and giving him a call. Also know, everybody, that Enid and Oriana, thank you. Or I think just Enid, thank you so much for navigating through the Q&A, the questions. We had a lot of great people on the chat side ask some questions, but if you can, let's place those into the Q&A so we can have those answered. So I'm going to start firing away. Rick, if you want to go ahead and see here. Okay. Glenn Friedman asked, how many second homes can you have?
So you can have up to 10. You can't do them all at once because your second home will have to get rented, and you're going to have to report that real income on your Schedule E on your tax returns. And then when that second home turns to be a rental, then you can go buy another one. So you can get up to 10 financed, but it's going to take you a little while to get there.
Exactly. And a good rule of practice would be to sit with a professional, let's say such as with your company, and say, here's my goal. Because you want to, if you're going to go down a path, you got to know, is that path not going to have a dead end that you don't want to hit? So it's good to talk to professionals. Gustavo asked, is AirDNA accurate? Is that information accurate?
I guess I'm going to have to be a lawyer. It depends. Uh,
Good
depends
one.
on the area you're in. It's just, it depends. So there's a lot of places, but there's a lot of stuff going on. It's going to be more accurate than in a place that's kind of scarce. So, but that's a pretty vague question.
Yeah, and Gustavo, one thing also, when you're using those types of vehicles to verify the validity of the performance, it's literally up to the underwriter or the lender to say, I'm only going to consider 50% of this viable. You need to come up with additional to make me feel better. So you got to consider that on how strong you're going to be in that presentation. We have this question here. What about for co-living rents? Are there that are typically higher than market rent? Will the debt service coverage ratio be based on the rent you are collecting, or would it be based on the market rent? I can answer that one.
Right, go ahead.
That's going to be based off of the market rent, because they're only going to make sure that you're covering the prevailing market rent to offset the purchase amount. Everything else additional hasn't happened yet. So they're going to use the comparable market rents for that. That was a great question. There's whoever the anonymous attendee was. Glenn asked, what are the prepayment penalties?
So for most loans, it's they call it a 5, 4, 3, 2, 1 step down. So on the in other words, the lender wants 5 years of interest guaranteed. So at the end of year 4, if you wanted to pay it off, you've got 1 year of interest as your penalty. If you can get now you can buy those prepayment penalties down, and usually they'll cost you anywhere from 0.25% interest, additional 0.25% interest and rate, to 0.5%, depending on how far you're buying down. So depending on what it is, I've had people buy down. I had one person try to buy, bought down to 1%, a 1 year prepayment penalty. He really bought into the Barry Habib thing and is thinking that a year from now, rates are going to be low, and he wanted to be able to refinance. He had to get financed now, but he wanted to be able to refinance a year from now. So, but yeah, anyway, so that's kind of what it is. They just want to guarantee interest. There are variations to that different lenders have. So you definitely want to go over that with your lender and understand exactly how their prepayment penalty works. Now, you can't do this on homeowners. Homeowners, you can't charge a owner occupant prepayment. So my house, your house, they can't do that. But on these commercial loans, they absolutely can do a prepayment penalty.
Perfect. Glenn Friedman also asked, can a recession cause rates to come back down enough to justify refinancing these loans over the next 1 to 2 years?
Well, absolutely. What's happening? I don't want to regress too much, but the federal government was pouring $70-80 billion a month into the bond market. And that's what caused rates to be low, because the government would accept low interest rates. Now so the government's doing two things. They're increasing the interest rates, and they're also accelerating the withdrawal of putting money into the bond market. So there's a huge void now in that bond market. So now investors have to come in and create and fill that void, but investors want a higher return. So that's what you're seeing there. You're seeing the investors coming in that void that the government's creating by not putting that money in, and that's what's caused those interest rates to go up. There'll be a point where, just like any curve, the bond market's going to get to a certain point, and then it'll start falling off again, depending on what the economy is doing. And Barry Habib's position is, when we hit that next recession, that's when we're likely to see rates fall, and that would be a great time to refinance. Mm-hmm. That may not be too far down the road, and it may not happen, but if it does, it may not be too far down the road.
And coming out of it too fast also might cause an adverse effect. So right. You got to be very careful. Great question there, Glenn. Christina Weaver asked here is on the owner financing, what does OFC and TGL stand for?
OFC and TGL. I had that on my slide.
I believe so.
Man, I gotta go look at the context. Right now I'm drawing blanks.
Okay.
That's a good thing about my age. I got a good memory. It's just real short.
I don't want to say this in the chat, but somebody who probably knows you well said, Rick Bresler hasn't cut his hair since 1979. And Enid almost fell out of her chair. So, Miss Christina, we'll see about getting that answer for you. Troy Covey asked, do you lend in North Carolina?
Yes.
Excellent. Troy and everybody else that's a SVI member, thank you so much for joining us. You can find Rick's information in the StratiVentures members network vendors directory in the member center. So feel free to go in there, guys. Let's see. Jenny Zhang asked, will the non-QM loan be reported on my personal credit report if the property is under an LLC?
Usually not. They very seldom show up on your credit report, which is a good thing and bad thing. If you're making your payments, it'd be nice that they'd show up.
Yeah, exactly.
If you're not making your payments, it's a good thing they don't show up. So, but yeah, most of, so usually they do not show up on your credit report.
Perfect. And Carl McKnight asked, what all markets are you lending in?
So we can lend across almost all the United States. There's 5 states that we don't lend in. California is one. And I forget the others. But there are 5 states we can't lend in. Basically, you got to have brick and mortar to be able to lend there. We don't, our resources don't have it. So, but all the important states except for California, we do. I don't consider California that important. So,
okay.
California listeners are on there. Apologize.
And feel free to email Rick or call or go to the webpage. Carl, you might be able to ask that in the form of an email. They might have that list for you. A. Burks asks, what is the maximum amount you typically lend for new construction, 4 to 8 plexes?
So 4 to 8. So now you're testing me. So it depends on your experience. Experience is the biggest factor in ground up construction. We like to see people who've got at least 10 construction projects under their belt and have done something similar to what they're going to build. And we can, so I'm confident that we can cover 80 to 85% of all costs on the multifamilies. On single families, it's higher. But multifamily is probably going to be 80, maybe 85%, depending on your experience and your FICO score.
Okay.
And then there's lots of other moving parts within that, but that's the basics.
Okay. Gustavo asked, do your vacation homes generate the most ROI versus your other property types?
For us, they're still in the experimental stage. I got one on Lake Travis who's just been kind of not really a pain in the rear, but I just had COVID really hurt the complex because of the management out there often kind of shut down and there was very little activity for a while. They closed the gyms, they closed the pools, they closed everything worth going out there for and enjoying except the lake. So that one is, when it's good, it's good. When it's bad, it's bad. But we like to go there ourselves. So that's okay. We're just starting a new beach house over on Bolivar Island. I think that's going to be a great thing. We're 200 meters from the ocean and 100 meters from the bay. It's an amazing property. We're going to put that on the market. I've got one by the hospitals over here off I-10. That's doing pretty well. My personal thing is I like to have vacation rentals where I go vacation and I can stay there. And that way I can go fix them up. That's just me. I'm not trying to scale. I'm not trying to get, a bunch of them. I'm not trying to arbitrage. Arbitrage is another good way to do Airbnb stuff. That's a different a different subject. And then the one by the hospitals, we just, I've rented that out for 8 years. I just wanted to try the Airbnb and to see if we can get enough extra. We only started Airbnb in that one about 6 months ago. So we had to come through the winter. So that one's doing pretty good. But it's also, what happens is I got a huge family, especially my wife's side. So we probably give more free nights than anybody else on the planet, because we got friends and family coming in from out of town, and we let them stay there. Gave up free rooms last week, free rooms next week. The family and friends coming into town, so it's good to have like a second home for us. People stay out instead of staying at our house when we're already packed. So anyway, the reason I do it's a little bit different than a lot of people. So I do it, but also just to say I can do them, and I know the ins and outs. And when I go finance them myself, it's always good to buy your own product and make sure, so anyway, so we do a little bit for little bit different reasons.
Okay.
But my wife's always looking for more.
Okay, perfect. And to answer that question with Christina Weaver, is OFC, does that mean Owner Finance Company? And does TLG mean the Lloyd Group?
Oh, okay. Yeah. So they're a finance company. And then
Thanks, Dante.
TL Global. Yeah. So those are two different people here in the Houston area that do what I kind of call seller financing, right?
Got it.
Well, so they do. So if you guys have properties for sale, you probably know this, probably only 7% of the population can can qualify for a conventional mortgage.
Right.
If you tap into those guys for seller financing options, they can help sell your properties, seller finance. So there's Jim Perez at your finance company to get a hold of, and there's Richard Whitmore at TL Global. So there's two folks to get a hold of if you want to explore that.
Okay, excellent. Thank you. The anonymous attendee says, how do you invest in Airbnb out of state without using property management company? That's the first question.
Well, I don't know you can do it without a property management company.
Okay. Then they wrote, my understanding is the use of a property management company will strongly negate any cash flow you may have. I live in California, so I find it difficult to find anything nearby that would make sense number-wise and would have exit strategies as well. Hence the non-funding in California, I would assume.
Yeah, no, you've got to, it's a hospitality business. There are some people that self-manage that got nothing else to do. But if you have a busy life, you've got to find a property manager that can handle, especially the cleaning and the maintenance. Real things are going to go wrong. But you've got to have someone. If someone's leaving at 12 noon and someone else is coming in at 4 o'clock in the afternoon, you've got to have a dependable cleaning person that can get in, get it clean, and get out, just like at a hotel. If you can't do that, you're going to fail. If you can't get 5-star reviews on your property, you're going to suffer. So, if you can't afford the property management and you don't have the time to stay on top of it and do it yourself, you're going to fail. So,
and I'm glad you brought that up, Rick, because I talk to so many people, members or non-members, and they go, do we go full passive investing with, let's say, our co-living models that we're building using pad split, or would you recommend going Airbnb? And sometimes I have to tell them, would you like a part-time job? Being the fact that Airbnb may kick out a good amount of income, you have to watch that machine. You have to, because again, any bad customer service review, any neglect in cleaning, anything like that, it will start a trickle effect on the negative side, especially with social media. I've known some people that they went from 1 year where it was producing amazing, 2 bad reviews, 50% of their business just gone. That becomes a job bringing it back to life. So you guys have to consider that. Andre Blackman asked, non-qualified mortgage loan will reflect on personal credit score even if the property is on an LLC. I think we've answered that one already.
Yeah, but it shouldn't. It might, depends on who your servicer is, but on most of ours, almost all the ones we use, that doesn't show up.
Okay. And Gustavo asked, how can I get 100% loan to value from you?
You got to buy the property for the right price.
Yep.
I mean, if you buy it deep enough, we can do it. If the those are hard to find, but there's people out there finding them.
Yeah, yeah. And let's see, Liliatha John asks, I hope I pronounced that right, and I apologize. Does it matter if the LLC is new?
No, it happens all the time. There's
Perfect.
people that buy a property in their personal name, thinking they may, either they didn't know better, or they thought they may go conventional. They had to keep it in their name. Or sometimes you go to the bank will want you to keep it in your personal name.
Yes.
Which to me is not a good idea. I mean, if you do, you want to get transferred into an LLC as soon as you can.
Got it.
But we have people all the time changing from their personal name to an LLC, or changing LLC names, or changing partners. I mean, things happen, but it's no problem. Resolutions, getting LLCs drafted, that's it's easy peasy.
Okay. And last question here, Jennifer asks, non-recourse loans cannot be used for a property one buys with an IRA funds, question mark?
Yeah, so I mean, there's people that have, let's read that question one more time. Be sure.
It says non-recourse loans cannot be used for a property one buys with with IRA funds.
Yeah, no, we can do, yeah, the IRA can definitely, the IRA is going to be the owner, not you. So the IRA is a separate entity. The IRA can be the entity, or you can have an LLC within your IRA. People do, there's one of the big gurus in town. He's got an LLC in his IRA that he owns hundreds of properties. So all this stuff is making tax-free cash. But whether it's in your, but we do IRA loans because it's the IRA company and they're doing an investment loan. It's not an owner occupied loan. And that happens not every day, but we do quite a few.
Mm-hmm. And last question here, an anonymous attendee said, any recommendations for property management companies outside of Texas?
Nope. Real estate's local.
Yep.
Property management is local. You're going to have to find somebody, and you don't want to make a mistake on that either. You don't want to find out the hard way they're not a good property management company. So you need referrals and stuff, which that's what you're asking me for, a referral. But no, I don't know. There's organizations like iTrip and Baycasa and stuff, but that's local as well. They may be national, but whoever's handling it in that area could be good. Whoever's handling it may be bad. You just got to find out who's running that branch or whatever. Get more than one referral, because you don't want to make a mistake on that.
Right. And also goes to the fact of, with us, for example, is we do not buy real estate or invest in any market unless we have personally gone there, walked the streets, gone to feel the environment. I myself, when I buy property, I go in the morning and I go in the afternoon, because you have two different neighborhoods, one in the morning and one in the afternoon, right? You got to see, is it Mardi Gras in the afternoon and, Sunday morning every day and during the day? Because those are things that will impact the people that are also going to your properties, guys. And Rick, you hit the nail on the head. Real estate is local. So here's Rick's information if you want to call him about the areas in which they are financing in, and also to get his perspective of how Katy Capital Investments works, because all our members use you. You've been a phenomenal person to us. We really appreciate you guys working with us. And so I want to also thank all of the other vendors that work with the StratiVentures members. Just make sure, if you want to find out more about us, hit the QR code and scan. You'll be able to see more about us. And I think Enid was putting out there to receive some free one-on-ones that we have to offer. We cover everything that has to do from the new construction, renovation, passive investing, private money lending. And we always talk about our vendors there, because if we help you analyze a deal and we go, you need to go talk to Rick, we're sending them over to Rick, because it's about staying in the lane of where you are working in. Also, let me see here. Yep, they just updated it. Feel free to send us your contact information, or you can go to info@strativentures.com to send us an email for the one-on-ones, or you can go to our landing page, investorrealestatetraining.com. Or you can also go to the new updated StratiVentures.com webpage and you'll see more information about us. And Rick, I know that in the investorrealestatetraining.com, there's our affiliates webpage, and you're one of our affiliates. Feel free to sign up for your one-on-ones or get information through Rick's company there, because Rick spent his time today to give you guys great information. We'd like to go see about maybe potentially in the future paying it back to you, my friend.
Thank you, Diego. You have been an awesome supporter of us and appreciate every opportunity you give us.
Yep, you're awesome. Oh, by the way, tell us about your Wednesdays.
Oh, yeah, that's right. So at the fourth Wednesday of every month, we've got a meetup at Quest Trust Company off of Park Row and Park 10, Park Row and Park of Cypress. So it starts at 6:30 for the social networking and such. We kind of get started with the presentations around 7. We've had really good turnouts the last 3 months. We've got a few vendors that are there. So if anyone wants to show up, just let me know. BMW Law, Troy, Diego, comes over, and we got a few other vendors that I think Real Estate IQ is going to be there. But anyway, we got some vendors that are there. They're good to talk to as well as centers around the BRRRR strategy. So it's for the Houston buy and hold community. And so this next Wednesday, we're going to talk about what's going on with interest rates. I'm going to get a little bit more of what Barry Habib's been talking about, and then also how to analyze your deal in 5 minutes or less. You've seen our deal sheets and stuff. We're going to show people how to look at deals. We're getting a lot of requests in, and people do not know their numbers.
Oh my gosh, that's
put
the big
in
thing.
$5,000 earnest money, and they send me and they give us the deal sheet back. I'm looking at the deal sheet. I call them on the phone. What were you thinking that makes this a good deal? Is a $100,000, $120,000 property. The way it was working out, he was going to leave like $60,000 in the deal.
Yeah, that's not...
And he had no idea. His realtor didn't know how much cash he's going to leave in the deal. When I showed him this is what's going to happen, so I think I saved him and numerous others from making big mistakes. So anyway, we've been getting an avalanche of those lately. So I think it's time to go talk about that. So that's going to be our subject matter for this Wednesday.
Excellent. And Enid, if you're there, reach out to Rick. Maybe we'll do a sponsorship for the next one for you guys, because that's definitely something that we've heard good things. We've heard very good things about that community group you got there.
Oh, good.
So for everybody that's joining us this evening, remember, you can scan the QR code. You can check us out on all social media platforms. Subscribe and like us on the subscription to YouTube, Instagram, and Facebook. This and Rick's information is always going to be on our platform, and also on the channel. This is going to be put out there, so people who didn't get the recording will be able to see that. So Rick, for your list of people that you sent your invite to, it would be great that you let them know that recording is going to be on there through you guys, because a lot of people were asking, because poor Enid was just
I apologize for that.
Okay, it's okay.
Rookie mistake.
No, it's perfectly fine. All right, everybody, thank you so much, and we appreciate everybody that joined us. We did go over time, but it was great information, and we look forward to working with you guys within 2 weeks. The next Monday, we're going to have another speaker. So Rick, have a great evening, and great evening to everybody that joined us.
Thanks, guys. Good night.